Consultants make more than a decent salary. And after you've fulfilled your basic needs, what do you do with all the money you saved?
I just stack it up. Keep it dry, spray it for silverfish.
What do consultants actually invest in? Is it all about the juicy insider trading? Well, let's find out. Alright, so in order to simplify the topic, we'll focus on two overall investment themes: individual investments and aggregated investments. By individual investments, we mainly mean corporate stocks and bonds. Aggregated investments mean that one security, so an individual stock for example, only accounts for a tiny fraction of the instrument. We're talking about things like exchange-traded funds, or ETFs. You'll soon understand why we chose these categories. So let's start with individual investments, specifically with equities and fixed income instruments. As a consultant, you'll work on projects for listed companies that are not disclosed to the public yet, or ever will be. So you'll likely have access to insider information. What is insider information? Insider information is a fact about a listed company that is not yet revealed to the market and that has the potential to influence the price of securities of that company if disclosed to the public. And with that definition, you can probably tell where this is going. If you trade based on insider information, you're committing insider trading, which is illegal.
I was working in finance and I got involved in some insider trading. So I spent a little time in the clink.
Given that consultants work on highly confidential projects, you'll come across insider information all the time. Therefore, consultants are not allowed to invest in any individual stocks or corporate bonds. This also includes derivatives linked to individual companies. A couple of years ago, investing in individual stocks or corporate bonds was still possible after getting clearance by compliance. For example, if you were working on projects for Nike, you could still get an exemption for buying, let's say, Sony stocks. So as long as you were not investing into your clients, you were basically fine after getting clearance. But consulting firms realize that consultants in the same office may talk to each other about projects, even if they're not supposed to. So to avoid that, and to eliminate any incentive to do so, consulting firms have become more restrictive. To avoid even just the appearance of impropriety, at most firms it's not allowed to invest in individual stocks or corporate bonds anymore. At least officially. Because actually, people do invest in individual stocks. But they basically never do so in the spirit of insider trading. Hardly any consultant has some groundbreaking insider information that hasn't already leaked, or that would cause a noticeable swing in the stock price. It's rather just that they don't want to miss out on the next Nvidia, Tesla or Amazon opportunity. And consultants are usually quite overconfident guys who think they actually can identify such 100-baggers. But is it worth the risk of getting fired and spending some time in the clink? Probably not. And that's one of the bummers if you work for a major consulting firm. Alright, so individual stocks and corporate bonds are off limits. But what about investing in real estate? Investing in individual rental properties is actually quite a common theme among consultants. The reasons for that are manifold. First, investing in individual properties is not prohibited, so no need to disclose anything to compliance for approval. Second, given the salary of consultants and the good credit rating, it's relatively easy to get attractive financing for rental properties. And third, the leverage effect. If you manage to use debt to invest in your rental properties, your return on equity can skyrocket. To keep the numbers simple, say you're buying a property for 100,000 and make a rental income of 10,000 per year on it. 10% return, that's pretty good and comparable to the S&P 500 over the last 100 years. But if instead you only invest 20,000 and the rest you finance with a mortgage, you'll make the 10,000 rental income minus, say, 3,000 in interest for the mortgage, so you make 7,000 on an initial investment of 20,000. That's a 35% return right there. That's all very simplified, but in a nutshell, that's why real estate investments are financially attractive. Of course, high leverage comes with a lot of risks, but as this is not a finance channel, we won't go into the details. If you want to learn more about finance-related topics, let us know in the comments. Next up, investing in non-publicly listed companies. What we mean by that is acquiring a share in a small or mid-sized company, or investing in startups or scale-ups. Investing in mid-sized companies is more of a partner or senior partner thing, given the high capital requirement. A more junior consultant might take part in a crowdfunding campaign for a startup. You could invest in total strangers, but also into former colleagues. The upside here can be huge, but more likely, it will go bust. In any case, investing in startups and scale-ups is usually allowed at consulting firms. Now that we've covered individual investments, how does it look like with aggregated investments? Just to recap, aggregated investments are investments in which the share of an individual stock or bond is only a tiny fraction of the total instrument. Basically, we're talking about funds, be it mutual funds or ETFs or any other such instrument. For example, an S&P 500 index fund includes 500 individual equity positions. Apple, for example, accounts for about 6% of the index. For aggregated investments, the rules are clear. You can invest in them as long as no individual stock or bond makes up the bulk of the index. So if Apple were to account for 30% of the S&P 500, it would be a bigger issue. But with all the large, well-diversified funds, you are perfectly fine. So investing into passive instruments like ETFs is absolutely fine, and most consultants do that on a regular basis. But how about actively managed funds? So funds where the portfolio manager is actively trading stocks. This is also allowed and perfectly fine. The only condition here is that you cannot have an influence on the decision-making of the portfolio manager. Otherwise, you could just tell him, hey buddy, time to sell your share in Apple. We're doing a restructuring program with them as of next month. Obviously, that is illegal. Now finally, we briefly want to mention how partners invest. For them, pretty much the same rules apply. However, once you reach the top echelon, you have some interesting opportunities on top. Consulting firms can have their own investment fund in which you as a partner can grow your money. At McKinsey, it's called the McKinsey Investment Office. They invest in all sorts of things, including some less accessible asset classes such as hedge funds and private equity. Now before anyone screams, insider trading, yada yada, there are Chinese walls in place, and they are respected. The SEC said those could be even higher, but no misuse of information was alleged. In any case, this is another nice perk once you are a partner. And so that's basically it. This was our overview of how consultants can and do invest their money. That's quite an interesting question because most new joiners, for the first time in their life, have enough disposable income so that this becomes relevant. And as you can see, there are quite some opportunities in things like ETFs or real estate, but also restrictions on individual stocks to avoid insider trading. But now it's your turn. How are you investing your money? Did you ever skirt the rules? Did you ever have a hot piece of insider information? Let us know in the comments. If you enjoyed this video, don't forget to like and subscribe and activate the bell for more content like this. Let us know in the comments below if you have any questions or if there's a topic you'd like us to cover next. Thanks for watching and we'll catch you in the next one.